Hello, everybody. Kirk Spano with Investing 2020s and the many publications that I'm attached to. I'd like to give my mid-year outlook and game plan today, and we will cover really what's going on in the economy. And I'll start with, a lot of people ask me if my forecast has changed. No, if I don't tell you that my forecast has changed, it has not. So I want to go through what I said at the start of the year, see where the wiggles in the line are a little different than what I thought might happen, but where they're also similar, and cover what I think we're going to have to do about it. First off, I've been telling you for months to trim your large cap stocks. If I manage an account for you, you know that I've done that. If you had large caps, several people brought in large cap holdings over the last couple of quarters. NVIDIA, I trimmed a little bit before and after earnings. Microsoft, I trimmed a little bit. Facebook, I sold out of. So you go down the list and you take a look at what I've sold, what I've trimmed. It really is the mega caps and the super large caps. Why? As we'll see in a few minutes, they're really pretty overvalued. The rally that has happened really did not broaden out to impact the entire market, and I think there's good reasons for that. I think that the small caps are still the place to be, given that many of them trade for ridiculously low valuations. In fact, I was taking a look at one satellite company that has over $100 million of annual recurring revenue, and the market cap is below that. How can you make $100 million a year annual recurring at a 30% plus growth rate, which is what they have, and trade at 30% below your revenue? Normally, your sales rate will dictate a price valuation, a price to sales valuation, and it's never a fraction. It's never a fraction. It's always 2, 3, 4, 5, 6, sometimes 10 to 1, depending on growth rates and whether people are paying attention or there's FOMO going on. But a 2/3 price to sales, that doesn't make any sense. So I think that there's a lot of disparities out there in the market. I think the mega caps are overvalued. And of course, they impact the S&P 500 index the most, because the S&P 500 index is market cap weighted. So the top 20 or so stocks have really accounted for all the increase, most of the increase of the S&P 500 this year. Meanwhile, you have almost every other stock on the S&P 500 languishing. There's a few dozen exceptions, but for the most part, you've got 411 or 415. I saw the number the other day, S&P 500 stocks that have not beaten the interest rate you can get from a treasury bond. Think that through. Why would you take equity risk if you can't beat a treasury, which has essentially no risk in the long term, other than inflation risk? Treasuries typically trail inflation by a bit over the very long term, or match inflation. Actually, they match inflation. Treasuries over the very long term match inflation for the most part. Sometimes they're ahead, sometimes they're a little bit behind, depending on if interest rates are rising or falling. So I brought that up because we're going to talk about treasury bonds in a few minutes. So we've seen the large cap, tech in particular, lead the stock market higher in the first half of the year. People don't understand what the stock market is or how the ETFs are market cap weighted. So they're like, well, the market's up 12, 15%. I should be too. Well, a lot of people own 4, 5, 6 ETFs. They're diversified. They don't overweight the proper sector of the economy or the proper market cap of the economy at the right time. What did I say a year ago? I said I didn't understand why tech wasn't the safety trade. And what was my point? What percentage of all corporate cash do the stocks at the top of the QQQ, the NASDAQ 100, have? I said the number over and over again, but it's been a while. Your top 20 stocks on QQQ have 70% of the corporate cash, of all the cash on corporate balance sheets in the United States. How can that be? Well, it's mainly because of Apple, Microsoft, Facebook, Google, and a few others. Those companies have so much cash that if they were allowed to buy other companies anymore, they would just buy up all the good stuff. And that's why it's important that the Justice Department stands in the way of these giant tech corporations from pulling in companies to expand their oligopolies. When you have really 5 companies at the top of QQQ with about half of all the cash, the ones I just mentioned, I forget who I left out, you've got kind of a problem, don't you? Money and power, power and money. It's important to keep that in mind because we saw a long period where productivity did not increase. Why was that? I would argue one of the main reasons is that because those top tech companies owned so much of their markets and had so much cash, and Facebook was particularly guilty of this, that they bought up-and-coming competitors and crushed the others, stifling innovation, stifling productivity gains. And now we have AI out there, and as BlackRock and a few others have pointed out, the demand for AI is so strong that we're probably just finishing up banning practice. But when you take a look at the orders, what all the corporations are ordering, from little biofuel companies in California that get an AI-driven Rockwell system to companies that use Google or Amazon or Microsoft AI-based systems to help them with efficiency. And you are starting to see productivity gains again, even in the face of a tight labor market, which we got news on today. So the combination of a tight labor market and AI should drive productivity very high. We should see a boom in productivity over the next decade or two that allows us to stay at near full employment for a very long time. Now, what's interesting there is that because of the aging demographics, we are in fact going to need a lot more service people, highly skilled to moderately skilled, and even at the low end range for agricultural purposes. But mainly what we're going to need are a lot of healthcare aides, a lot of people who can work with an AI to do the equivalent of 2 or 3 jobs. We need a lot more doctors and nurses, a lot more. We need more engineers. So the whole range of jobs out there that we need as the boomers all retire, millions and millions of them, is pretty high. So some combination of immigration and AI should keep us near full employment for a very long time. The work week might change. I think it's going to be very hybrid. And I think you're going to get a lot of 4 and 4.5 day work weeks, or 3 full days and 2 half days. I think that is an idea that's coming. And a lot of these things get talked about all over the internet, from crummy little blogs to high-end publications. And there's a lot of bad information out there. But the one thing that's pretty clear is that the marriage of AI to work is happening. I don't know when the official marriage is planned for, or whether it'll be a destination wedding, or what the deal will be. But virtually everybody who works in front of a computer will have an AI assistant in the not too distant future. So the question becomes, with that secular trend, one of our 2 major secular trends, 4th industrial revolution, largely using AI, and how to deal with climate change, how will it all work out? What I think is that it's going to be a lot better than people fear. You have people running around saying we're all going to lose our jobs. Can't happen. There are just certain things that AI can't do. It still makes mistakes around 10% of the time, maybe 20% of the time. AI is more of a research assistant and a machine that'll collate things for you to make your life a lot easier. That major secular trend begs the question, where do you invest? Do you speculate on who is going to have the best AI? I think that's really hard to do. Do you buy a basket? Probably. I think where the biggest gains to be made on AI are which companies can use AI the best. We've talked about this before. So as we go through whatever volatility we're going to get in the market this year, we need to figure out who is going to benefit the most from AI, which is one of our major secular trends, and who is going to benefit the most from the energy transition. And that one, I think, is a little bit easier to figure out because all we have to do is do what? Follow the money. Which companies are going to capture the most in tax credits? That makes life pretty easy, doesn't it? Refiners that become 50% more profitable, the more simple carbon capture plans out there. And I say simple because the giant carbon suckers out of the air things, I think, are inefficient. Science proves it, and expensive. You just aren't going to have the margins that, say, turning an orchard into biofuel will, and then burying the waste carbon. So in the second half of this year, we should be looking to double down on our secular trends and probably invest most of the rest of our cash if the timeline goes as I expect. Now, that doesn't mean the timeline has to go as I expect. If it stretches out or if it condenses, whatever, we'll just adjust in real time. I think we're going to see a 10 to 20% stock market correction, and it could be more if the regional banks have a problem that is worse than what we've seen, or if there's some sort of international event. And I think that there probably will be, but that it could end up being a lot like the start of the Ukraine war, where 2 months later, the stock market is ignoring it. So you get a very fast dive, pretty quick rebound. With the regional banks, it's a little bit different because that process, which I described to you back in April and May, is going to take a long time to repurpose all these commercial buildings. I just talked to my daughter this morning. I've told you that we've thought about buying a building for her business and mine and to have a couple renters. I found 3 buildings under $1.7 million in nice suburbs that would allow us to do that. Because as retail shops continue to struggle and financing 5-year notes from 2018 and 19 becomes very difficult, the price of a lot of these strip malls and other sorts of buildings is pretty much crashing. I found a 10,000 square foot building in West Dallas, Wisconsin for $600,000. It has 4 spaces, going to need some remodeling for sure. So you throw in a couple $100,000 more for that, and you're at $800,000 for 10,000 square feet on one of the busiest roads in Wisconsin, near the Wisconsin State Fair, near new housing, and near the Milwaukee Mile, which at some point has to be redeveloped, and maybe even gets the new Brewer Stadium if any of the politicians use their brains, which, I don't know how many coin flips we have to do on that one. When you start taking a look at what's going on, I hope that the story that I've told over the last 3.5 years, really since CES 2020, that really opened my eyes, and following along and seeing how everything has developed should be pretty clear to all of you too by now, unless you're new, and I'll get you there if you're not quite getting it yet. The major secular trends drive the economy. The 2 biggest investment trends have to do with, and really 3, I always kind of put this on the side, but I guess it relates to healthcare. The 3 biggest secular trends out there are what? Aging demographics, climate change, and the 4th industrial revolution. And I'm not sure it's in any particular order. But if you put everything in the frame of those 3 things, you can find the winners. And you can avoid most of the losers. Doesn't mean that you're not going to see unbelievable volatility. COVID introduced a level of volatility that we've never seen before. Extreme overvaluation and extreme undervaluation. You can find both. You can win as a bear, you can win as a bull. Probably should still avoid being a pig. So if I had to make a prediction for the second half of this year, I'd say a 10 to 20% correction just on valuations on the large cap side and finishing up wherever else it needs to happen. But it could be worse with an international or regional banking shock. I think the Fed is going to raise interest rates in 2 weeks. I have to check the calendar. It's coming up. And that, I believe, will be either the last time they raise interest rates or second to last time. Maybe they raise rates one more time in September or the fall. But the only type of inflation that's not coming down dramatically is wage inflation. All the other forms of inflation are falling. OPEC can't keep the prices of oil and gas high globally as much as they try, because the things that I talked about happening by 2026 and 2027 appear to be a little bit ahead of schedule. I've said repeatedly that in 2026 and 2027, because of the laws in place on mileage and on clean air and on carbon, force the car makers and heavy industry and everyone else to start cutting their carbon footprint more than just a token amount. In the energy transition, they talk about being inflationary the same way they talked about big tech suffering from a higher interest rate environment, even though they had all the cash. They're just wrong. The energy transition is not inflationary. If OPEC had just maintained their production, the price of oil would be in the 40s right now. But they keep cutting it. They try to put a floor under it, and they're failing at doing it. Last year, 9% of all new cars were EVs in the United States. I believe it was a little higher in quite a few other markets, China in particular. That number is going to keep going higher and higher. And by 2027, which will be the last year for a lot of internal combustion engine models, in Europe especially, because of their rules and because of what Ford and GM have already committed to, and Volkswagen and Volvo and everybody else, then in the United States, you may see all internal combustion engine passenger cars, with the exception of a handful of models of expensive sports cars, maybe some mid-size SUVs that are hybrid. You're going to see almost everything go EV on the passenger side by 2030. But they're already closing factories down, and they're going to close a lot more of them down by 2026 and 2027. And that's when the car companies go, hey, we have a whole bunch of real estate that we're not using for cars anymore because it takes half the footprint to build EVs than internal combustion engine cars. And both GM and Ford are building big plants for that purpose. They're going to have buildings all over the Midwest and actually throughout the country, but mainly the Midwest and South, that they're going to have to find another purpose for. Either they can sell some of those properties, which they will, or they can use their fourth industrial revolution technology to build other stuff. Maybe become part of the military industrial complex. Maybe get into some sort of production of solenoids or something to do with solar or batteries for climate change. Ford and GM are in pretty good spots. Ford is the cheaper choice, and I think probably has the more desirable vehicles. That's the way I'm looking. I'm going to leave Toyota after all these years. I'm just waiting for the EV Explorer to hit the market. That's the way it's all going. So as all the companies announce breakthroughs in batteries, from Panasonic to Toyota to Ford to LG to Tesla, and everyone in between and on the sides and up and down, that's probably not what you want to invest in. The batteries are going to become commoditized, and every battery today will be obsolete in 3 years. I think we want to invest in the companies that just benefit from the batteries getting cheaper and cheaper. Car companies seem like pretty good plays. You know that I'm in Ford, been pretty public about that. I kick around GM, but they never quite get to the price points I want. I've never really figured that out why. I think just because so much GM stock is held in pensions. And that's a point that I would make, is that, again, just like I talked about the AI earlier, it's not necessarily the batteries or the AI or the thing that's going to be a commodity that you want to invest in. That's why I don't get super excited about lithium mining companies or any mining company. It's why the only oil or fossil fuel companies I invest in have something to do with carbon capture, or they're getting some sort of tax credit for the fuel that they produce. Oil is a dying industry. I crack up at the people who talk about, well, but we need plastic, man, and we need all this other stuff made from oil, man. It was so good in the past, man, other than melting the ice caps. We've been talking about a company called New Light, right? For what, 7 or 8 years now? Just watching them. And there's a couple others now. They can take carbon right out of the air and turn it into plastic. So why do you need oil? All right. And all that's coming too. And I'm going to look for places to invest in that. That was one of the things on the Bloomberg page, was it not? Go to the Bloomberg page again, hit green, and looky here, big plastic. All right. You should have Bloomberg. I mentioned it off here. I'll mention it again. If you don't subscribe to Bloomberg, please don't ask me what happened when the stock market goes up 1 or 2% or down 1 or 2%, or a stock goes up or down 3 or 4 or 5%. Usually the answer is nothing. Usually the answer is just traders being traders, the herd running from one pasture to the other pasture, hoping that the grass is greener. The idea that markets are rational is irrational. There's no other way to say that. I've been watching the stock market for, a really long time, since the middle 1980s, when one of my high school teachers, and I was blessed to go to a high school that had a lot of people that were professor level, but they had reasons not to work at a college, had us take a look at investing in the stock market. two different teachers, one sophomore year, one senior year, had us pick out stocks and then watch them for 3 months for a semester, which isn't nearly long enough. It encourages short-termism. What they should have done is coordinated. You pick out the stocks as a freshman, then you watch that basket of stocks until you're a senior across different social science classes. Over 3.5 years, you get a better feel than 3.5 months. And look, the headline switched for Bloomberg. The U.S. is building factories again. Just sort of talked about that, didn't we? Right? Ford, GM, they're going to have all sorts of industrial real estate come available in the next few years. Stag Industrial, Prologis. You have to stick with the major trends, then dig down to see who can really increase their revenues and margins. And you're going to be a huge winner. Now, why do I think we see a correction now? Because valuations are out of line. Legendary Investor says the stock market has a 70% chance of crashing. I will remind you that 10 to 20% is not a crash. I think that he has overstated this, but he's also kind of couched his bet. He's still saying from the top in 2021. He did call the crash for .com. He called the financial crisis, and he called the top in 2021. I, too, should be a billionaire by that measure. But he has a lot of other people's capital to manage and collects a pretty big fee. Again, I believe a crash comes if we get international event or regional banking crisis. I think really what we should just focus on is that forward price to earnings ratios are a little bit out of whack. Not as bad out of whack as they were in December 2021, but they're still pretty out of whack. Now, if we don't get a correction and the stock market goes up 10 or 20% instead, now we get back into bubble territory. I think it'll be healthy for the stock market to correct to somewhere in the 3,000s on the S&P 500. Right now, if I had to pick a spot, I'd say that we test the October bottom from last year. It holds, and then we rise from there. We'll see. If we go through the October bottom, something bad is going on, and we probably go lower. Now, do we care about the broad market? No, it's just kind of an indicator of mass sentiment and a way of picking out how close we are to everything being at a bottom. The SPACs and the small caps, to me, probably hold up pretty well here because money is destined to get looser again. The federal government cannot afford interest rates around 5%. They need for interest rates to get lower to around 3%. Otherwise, we have some big financial problems. Over time, we probably get a massive credit contraction. Massive credit contraction in the next few years, it would be very financial crisis-like. We don't want that. And that's why I think the Fed is almost done. I think that if they really go after the labor market, that we're all in big trouble. Because what we are seeing right now, for the first time since Clinton, a little bit under Obama, but really under Bill Clinton, you had the middle class expand again. Shrunk under Bush, stabilized under Obama, shrunk under Trump a little bit, and now is starting to grow again. Why? Because everybody's employed. And labor has some bargaining power again. Because the labor market is tight, it's hard to fire people, and now people are keeping their jobs. What are we seeing now? Americans have quitting their jobs. That's good. Now, I will say that most people are still financially irresponsible. They're not paying down their debts, and they're not saving. They're out there just kind of having a good time. But eventually, you would hope that if employment stays high, but the mood or the sentiment is only maybe neutral, hard to know if it's negative or positive or neutral right now. Everybody seems to think it's negative, but people keep buying stocks. People keep going to the beach. People keep going on vacation. People keep eating out. They keep buying stuff. If we get a recession, I'll stick by. It's going to be short and shallow, kind of over the fall into winter, into spring, maybe 6 months sort of thing, 2 quarters, maybe 3. But it's not going to be negative 5% GDP. It's going to be like right around zero growth. So what? Wear your socks an extra couple months. Big deal. Job openings dropped after a big increase last month. So now you can see it's kind of going up and down. And I would posit that it takes a month or two, not a week or two, no instant gratification here, for markets, labor markets included, to work things out. And with the advent of AI, I think you're going to see a lot of people change jobs, but I don't think you're going to see fewer jobs because the baby boomers are retiring. And we still don't have enough people to replace them. And we don't have enough people to help take care of them. Still going to need immigration, even with AI. And luckily for us, climate change is so bad, plenty of people are going to want to move here. Yeah. That's why Jolene is getting into real estate, because Great Lakes real estate is going to go through the roof. I know a couple of you, and I have one of you that I have to get information for, are looking to get into that private equity deal that I brought a while back for some luxury apartments. And there's going to be more. And I would encourage you, if you live in a place where you worry about the climate and you have a way to finance another property, you ought to be looking in the Great Lakes region. We can help you in Wisconsin. We're going to be hooked up with Keller Williams. So really we can help you with every state. But any of the national brokerages for real estate probably can. You have to be able to tell them what you're looking for. Because as far as I can tell, we're among the only ones, and she'll be handling the real estate end, but I'm doing a lot of the economic analysis. I think we're the only ones providing economic and climate resiliency analysis for real estate as core to her practice. I'm her consulting economist, as it were. So going back to the quits are starting to come down. Why? People want the money. They're finally getting paid for what they do. Remember the whole $15 an hour thing for minimum wage? Doesn't much matter anymore, does it? You can't hire anyway for under $15 an hour. I mean, maybe teenagers for some fast food stuff, but even they're pushing $15 an hour in most cases. And this is in the Midwest. I know on the coast, it's $20 an hour, which, just to point out, $20 an hour is only 40 grand a year. So I know I hear people go, oh my God, $20 an hour to work at McDonald's. Yeah, bro, that's 40 grand a year. You live on that. Still tough. So understand these big secular trends, and you will understand where to invest. This June was the hottest on record. We keep breaking climate temperatures, all the records. We keep breaking all the records. The drought's not over. The ice caps are just melting, so it's a little bit temporarily moister. What happens if the temperature goes up another couple of degrees? Oceans start to evaporate. You get more storms. That's why the hurricanes have been getting more violent. Brad Thomas and I had an interview a couple of weeks ago where I interviewed him, and all his followers along him, drum pounders, got mad at me because I said, there's no way I would invest in Florida. You know, Brad took the other side. Well, Florida's booming. Yeah, well, I happen to know that private equity firms have started to pull out. Private equity investment in Florida just peaked over the winter. Maybe they get a plateau for a year or two to finish up projects. Private equity is not looking to invest in Florida. 2/3 of the insurance companies have left. Now, Berkshire is talking about going back in because now that rates are so high, they can kind of write their own ticket. Kind of like a female drummer, right? If you follow rock and roll, you know that female drummers pretty much get the gig. Well, Berkshire is going to get the gig in Florida because they're the strongest insurance company in the world. So they'll be able to dominate that market, even at higher rates, because people are going to want to know that when their house blows over, the roof flies away, Berkshire can write the check to replace it. Of course, the premium is going to be much, much higher. And Berkshire will play the arbitrage on newer constructions versus older constructions. The new constructions are more climate resilient. The older ones, they're going to float away. I talked about how Florida, Miami in particular, but really all the way around the whole tip of Florida, from Fort Myers, which just blew away, all the way around up to north of Fort Lauderdale. They're looking at building the types of walls that they have down in New Orleans. New Orleans built a football field wide wall by the Mississippi River, 30 feet high, and extended it half the length of the city, from downtown all the way down to Frenchman Street and beyond. Florida is going to have to do that. And as my father pointed out, and I hadn't really thought about it, they better do it right, because otherwise they're just going to have a giant swimming pool when it rains. So not only do they need the wall, but they need fantastic drainage and pumps. They're going to need pumps, which I guess you put on top of the walls and you solar power them and batteries and hope the ocean doesn't go high enough to wipe those out. I'm not really sure how you do it. It's going to be an engineering marvel if that's what they decide to do, and it sounds like they are. Do you want to pay for it if you don't live in Florida? Probably not. Cost of Florida living is going through the roof. You can have no income tax all you want. I've done the math. To have a property in Florida and have it make financial sense, your income has to be $400,000, $500,000, $600,000. All the people trying to do it on less than that, they got a big problem coming at some point because the cost of living is just going to keep going up there. And things are going to get torn down, then they got to rebuild them. The federal government probably isn't going to rebuild anybody's house. They'll rebuild a hospital and a school, but they're not rebuilding your house. And I get argued with on these secular things all the time because people tend to look in the rearview mirror versus looking out the windshield about what's going to hit them. Climate change is a big deal. You have to be on the right side of that. Carbon credits are a direct derivative of climate change. Fourth industrial revolution technology is going to solve a lot of things there. Aging demographics, we know that we need deflation in healthcare. AI is going to help with that. If we don't get deflation in healthcare in the next 10 years, we're in big trouble. But I'm pretty sure we're going to. So stock that we're coming back to is likely to be a big player because of their databases in bringing along healthcare deflation when that data is combined with AI. We already know that Watson is helping, Google and Amazon, Microsoft, they're all in it. They all know that one of the next giant markets is trying to create healthcare deflation. That's why United Healthcare a few years back, and I still think they're a crappy company. I don't like management at all. They'll figure out a way to blow it up. They went heavy into data, and they're going to try to survive during a deflationary period. And that's what they were preparing for. I will say that they saw what was coming, but just like the oil companies knew that climate change was being caused by them largely, United Healthcare knew that the expanding healthcare GDP in this country is largely because of them. So they took part in breaking things, and they're going to try to make money on the comeback. It's sinful as evil, but it's the way it is. Now, United Healthcare is an expensive stock. Maybe they just chop for a long time. Other stocks, well, maybe you ought to dial your telephone and call your doc because those stocks are cheap. This correction, small or big, here, there, now or later, is probably the last chance to get in on a lot of these things at super cheap prices. Not that you can't buy them in the future, try to ride the momentum, but there are a lot of stocks out there in that small and mid-cap space, things that went from loved to hated. I have never seen so many small and mid-cap stocks so ridiculously cheap against their growth rates and the growth that nobody is willing to acknowledge yet, other than a very small handful of people. And that's where you want to be. You want to be in the small handful of people. You don't want to be the crowd. The crowd over the last 40 years has averaged about 3% on their investment portfolios, despite the stock market going up whatever it's gone up, a zillion percent or something. The crowd, the market, has been wrong over and over and over again. So my last message here is this. Be a contrarian. Look for the things that are beat to hell just because people don't understand them or assign value to what they do, but that you can discern there's value there. There's a business that makes sense. It has some big investors or has tax credits or whatever. Look at what the private equity firms are doing. If you really want to know the market, go read KKR or Blackstone or Apollo's reports. Ignore all the other shit. Private equity firms are vulture hunters that bank on 2 to 4 years out. They have crushed the stock market over my career. It's why I have started to gravitate in that direction. Probably something I should have done 20 years ago. By the grace of a couple good friends and some folks who gave me a shot, I'm starting to figure it out. So we're going to invest more and more like private equity investors. We're going to start ignoring the market even more, except when it gives us an opportunity. We're not going to worry about, oh, look, the S&P 500 went up 10% in the last 6 months. Yeah, well, we bought a stock on May 6th that's up 500%. All right. And we're going to buy real estate with internal rates of return of middle teens. And when interest rates come down, those internal rate of returns probably jump up to over 20, secured by real estate and rents. If you only care about making around 10 or 15%, it's easy to do real estate with interest rates at these rates, at these heights, which is just historically normal. So I'll finish on this. What the Fed has been doing is the great normalization, bringing interest rates back up to normal rates, not high. If you think interest rates are high, you're completely wrong. Historically speaking, these interest rates are normal. It is part of the management of the dollar and of the debt and of the United States' future growth. With the exception of several emerging markets, the United States has got the best growth outlook in the whole world. And they keep proving it over and over and over again, right? I mean, the American economy just keeps proving it. The gift of the best real estate on the planet, best geography, neighbors who are benign. I mean, we have some problems on the southern border, but frankly, a good immigration policy and, build some small towns for intake and they'd all be fixed. But, they're not white. And not being white is kind of a problem for some people in this country. And if we start treating everybody like a human, probably be much easier. All right. Somebody online called me a hippie, left-wing, libtard, something or other. I would just like to respond to that. I, in fact, did drink Bud Light in college. I don't like the taste, but anybody who does like Bud Light, I don't have a problem with you. I believe in a lot of things that are very libertarian, in fact. I don't think religion should be mixed with politics or government or the law. And I think that a lot of these guys on the far right wing who don't like me because I don't want to be in their club, well, I'll just say this. Here's the joke that I put on Twitter, which I don't know if anybody reads anymore. I think the Democrats could run a corpse in 2024 and win the presidency. Okay, what's the punchline? And they just might do it. I throw that out there because a couple days after Independence Day, I'm reflecting on some of the things that I saw and heard in Vegas when I came back to town. I'm always the one who says, look on the bright side of life. And I think that's important. I also think that it's important that you do what you can to make it a brighter world. So as I helped you make filthy amounts of money, I would ask you, especially when it comes to grandkids, nieces, nephews, and kids, to look for ways to make sure that they aren't depressed about the outlook. Because I have realized in hearing some teenagers of the parents that I hang out with, my kids are in their 20s already. There's a lot of depressed kids out there. And frankly, it's the adults' fault. So take the other side of that bet too. Be positive and help a kid think positively. And then go out and vote accordingly. Leave your religion in your church, synagogues, steeple, whatever, and look at people as people. Because if we do that, boy, it's going to be a pretty good place. Because the AI is going to make our work easier. Eventually, we'll fix climate change. And somebody's going to open up a pretty neat restaurant that you'll want to go to someday. So have a good day. Enjoy the second half of the year. Look for spots to get more involved in the secular trends. The correction may come, it may not. It may come sooner, it may come later. It'll always come. We just don't know exactly where and when or how. If we avoid a crisis of banking or international conflict, 10 or 20% retest of the October lows from last year, you'll get your second try. In the meantime, take a look at the new plug and play and the new Global Trends ETF over the weekend. And I think that you will understand even more what I'm talking about. We are on the verge of what I'm going to call the millennial boom. And we are going to see a tremendous expansion of the global economy as the rest of the emerging markets become middle class over the next 20 years. All right. Have a good one.